Okay. Hello, everybody. Welcome to Money Matters with Huong, your host of Money Matters from Cash Property. So we are going to get started. It is August the 5th, and today we are going to talk about how much are you actually saving going from a variable to a fixed rate, and should you be doing that now or waiting a few more months when the rates are expected to go down a little bit more. So let me see, what else can I tell you about today? Oh, so yes, before you go and implement this stuff, please do go and talk to a financial advisor. Make sure you talk to your mortgage broker as well. Okay, so let's hop right into it. And before I forget, the mastermind is happening on the third Friday of every month. So even though it's the middle of the summer, we are still hosting one. So if you want to get invited to the mastermind, it is by invitation only. It is on August the 16th. It's Friday night, and it's a great, safe place for you to come and learn about real estate and put out your challenges that you're having in real estate or money issues. And the group that is on the call will work with you to give you some ideas on how to get through that. So that is the monthly mastermind. Okay, so let's dive into, let's see, this spreadsheet here. So if you want a copy of this spreadsheet, just email me and I will send it over to you. The thing with this spreadsheet is that I am not liable for any losses or any damages or anything like that. Please run through it. The spreadsheet is given to you as a way just for you to look at the numbers from a different way. Usually what I would recommend is that if you're in a situation where you're in a variable rate and you're like deciding, should I switch to a fixed now, or should I wait 3 months, or should I wait another 6 months? Just phone up your current bank and ask them, hey, how much is it going to cost me to switch my mortgage out from variable to fixed? Can I do it? And just ask them all the questions that you need to ask them, because there may be a penalty, there may not. You may be able to switch over at the very next payment. They may say, no, you have to wait 2 payments down, depending on if you're on monthly or a weekly payments. Okay, so there's a lot of other things to consider with this question. So what I want to do is just sort of lay out the question here, because I was in this situation 6 months ago, and so I went through a similar exercise, but all of us are in slightly different situations because our mortgages are started at different terms. The amounts are different. My mortgages usually are investment properties, so there's a different consideration if it's your primary property. Okay, so let's just run through this. So the situation is that we're in a variable rate and we're wanting to figure out, should I switch to the fixed rates now? And right now, we haven't seen this in years and years and years, and all suddenly since COVID, because the rates have gone up, the variable rates now are higher than the fixed rates. And so that's creating a lot of issues for a lot of individuals. So the question is, do we switch over now, or wait until September, or wait until another rate decrease supposedly happens? Okay, and of course we don't know when that's going to happen. We're sort of speculating that in September it's going to go down a little bit more, and then the next one after that will go down a little bit more. So the question is, do I wait? Okay, and then consider rates now. Okay, so what we want to do is go through the exercise of considering what are the rates now and what will they be later. We don't know what they'll be later, but we're sort of guessing. So during COVID, I was like, there's no way the rates are going to go above 2% more than where we are now. Like, there's no way people can handle it. And lo and behold, they did go way above 2% more. But unfortunately, the reality of that is that a lot of families, a lot of investors are not able to handle that increase. Okay, and so we're seeing a lot of that backlash right now. So if we think that the rates are going to be lower in 6 months, is it better to wait, right? So, because the thing is, once you switch over to the fixed rate, you're locked in on that for the rest of your term. And if you want to switch again, there's going to be a different type of penalty depending on how your lender calculates that. Okay. Now, you don't need to do all these spreadsheets, and you don't need to sit with me or anybody else to do the calculations, because all you really need to do is just call your lender up and they will actually do the calculations for you. Okay. I myself like to understand the numbers. I like to know ahead of time, okay, if I do A, B, or C, what the effects will be. And then that's when I call up my lender and I'll be like, hey, you know what? If I do this, is this really what's going to happen? If I do B, is this really what's going to happen? Part of that is my understanding around money, and so that I can leverage my portfolio the way it is, right? Now, if you've only got one, two, or three properties, and you don't really worry about wanting to grow a big portfolio, then maybe getting into this level of understanding isn't that important. Okay. Okay, so the other thing to consider is, what is the penalty to break your mortgage? Because you're going from variable to fixed, like I know in my case, to go from variable to fixed, there wasn't a penalty. It was basically me phoning them up and saying, hey, I want to switch from what I have right now, which is variable, to a fixed rate. And it would be for the rest of the term that I had left over. If I wanted to extend it, if I wanted to increase the amortization or anything like that, then there may be a penalty, and then it was considered a refinancing. So you need to understand that part. So in my case, I was just basically like, I think I had 3 years left, and I was able to just switch over without any sort of penalties. And I think I was on weekly payments, which is usually what I do, accelerated weeklies. And so they were just able to say, okay, on your next payment, once all the paperwork goes through, on their very next payment, that's when your fixed rate's going to kick in. Okay, so the big question is, how much will I actually save? And then how much is actually left in your mortgage? So the big thing that I want to make sure that you understand here is that when you go from variable to fixed, okay, you're not able to go back, okay, to variable. You're basically then locked in for that fixed rate for the remainder of your term. So that's an important thing to remember. This isn't for the rest of your mortgage. It's not like for another 20 years. It's not for another 15 years. It's really just for the rest of the term. And so when you signed up at the beginning of your term, most likely you signed up for like a 3-year or 5-year term. So when you switch over to a fix, it's really just for the remainder of that 5-year term. So the numbers may not be as big as you're thinking. It may not be a big of an impact, is what I'm trying to get at. Okay, so let's just run through the scenario here. So I ran through this yesterday, so I'm putting yesterday's date. So just follow along with me here. So yesterday's date, okay, and the current mortgage that I have on this scenario that I'm running is roughly 277,000. So I'll show you where I got that. Everything on this sheet is being pulled from the calculations except for the date. And this one number down here, this one would have taken some time to write up a formula, and I didn't do that. I just basically said, hey, you know what? Just remember to go in there and manually pull the numbers out. Okay, so the current mortgage is 277,000. The current variable rate is 6.10. Now, you may have a slightly different variable rate depending on how your lender is charging you on that. In this case, I'm just running 6.10. Okay, so the weekly accelerated payments are about $484. And that means in my term, so I think in this one, I ran with a 5-year term. Yeah, so I did a 5-year term here. And this mortgage example, we pulled it in September of 2021. So in 5 years' time, it would be 2026. So based on today's date, we would already have done about, 2.5, 3 years. So that's why this, where did it go? This year. Okay, so this is the time remaining on my term. Okay, so that means I only have 2 years left. So any potential savings I have from going from a variable to a fixed is only going to be recognized based on this 2-year term. It's not based on my 5-year, not based on 25 or 20 years. It's just based on the 2 years. Okay. And the reason why I'm saying like everybody has a slightly different situation because it depends on all of these variables that go in here, right? Like your mortgage may be higher, your interest rate may be higher, your amortization may be slightly different, the date that you started your mortgage may be different. So there's quite a lot of variables, but once you just input it in, it spits out the data for you. Okay, so let's go back to the summary sheet here. Okay, so what I'm trying to figure out is, in my first scenario, does it make sense to switch to the fix now? Okay. Or in scenario 2 is to switch to the fix, but hold off on it because I think the rates are going to go down even more. Okay. And this is an interesting conversation because you would think, okay, well, if I'm at 6% now and I think the rates are going to go down, let's say to 4% in 5 months or 6 months. So I'm running this in, like, say, I think it was January. You would think that you would save more because you'd be better off waiting until you get down, by almost 2 percentages here. Okay, so let's run through this the scenario here. So scenario 1, I switch to the fixed rate now. So I just phone the bank up and I'm like, hey, I want to switch from my variable to my fixed. So I'm not going to wait. Okay, I'm just going to switch. And let's just say the bank comes back and says, okay, great. The fixed rate now for the remainder of your term is 5.04. That means that instead of paying $484 every week, accelerated weekly, I'd be paying $423. So it's about a $60 difference here, right? So yeah, so $61. So that means it would be about a $3,169 in savings per year. Now, because it's only a 2-year term remaining, it's about a $6,600 for the rest of the term. Okay, so now what happens at the end of this 2 years is the bank's going to send you some documents and you're going to just renew or refinance depending on what you decide. Okay, and hopefully by then the rates would also have gone down significantly, and then you can lock in for another period of time if you want to. Okay, so that's the scenario 1. Okay, so the way to calculate all that is I have this main spreadsheet, and this is from CMHC. It's not a spreadsheet that I developed. However, I've been playing with this spreadsheet for years, and I have added some stuff to it. Okay, so what we're saying here is that we're starting with a mortgage of 300,000. So the house is probably worth, 350, 400,000, but I took out the initial mortgage for 300,000. The rate is 6.1. They gave me a 25-year amortization, and my first payment started in 2021. Okay, going accelerated weekly. Highly recommend going accelerated weekly or accelerated biweekly. Those are the two things. And if you don't know what I'm talking about here, check out some of my other videos on how to become mortgage free in 10 years. Okay, so that's one of my coaching programs that I offer, is how to become mortgage free in 10 years. And going accelerated weekly or accelerated biweekly automatically takes about 2 to 3 years off your mortgage. So this 25 years becomes about 22, 23 years. Okay, so the accelerated weekly payments is 484. Okay, so in 5 years, my interest paid would be $82,000. Okay, now here's the interesting thing. That means that my principal paid was only 42. So if you do the math on that, 50% of my payments went to pay interest to the bank. Okay, that is absolutely crazy. So my outstanding balance in 5 years, assuming that my rates haven't changed because I'm on variable here, okay, it stays at 610 the whole 5 years. My mortgage at the end of the 5 years is still $247,000. Okay, so basically I haven't really, I haven't paid that much off. Okay, so that totally sucks. The other thing that I want to, really show you here, my mortgage started at 300,000. At the end of the 25 years, okay, assuming that it stays at 6.1% for 25 years, at the end, I would have paid almost an extra $200,000 in interest to the bank. That meant that I would have paid more than double for my property. So in this case, 66% more for this $300,000. Okay. That's why I'm constantly pushing. Like, if this is your primary residence, pay off your mortgage as quickly as possible. Like, this is at like a criminal interest rate. Like, it's insane. Okay. So if you take nothing else away from this call, please just make sure you like pay off your mortgage as quickly as possible. There's other things that we can do with your mortgage once it's done that's more efficient, money wise and taxation wise. But if it's your primary residence, please, please, please learn how to pay it off as quickly as possible. Okay, so this is the variable rate. Then what I've done is I've added 2 additional tabs at the bottom here. So one is fixed, okay, and it looks exactly the same as the other sheet. It's exactly the same. It's just that now we're using it as a fixed rate. And then we also have this other fixed one, which is we're going to run the scenario, but we're going to wait 6 months or 3 months down the road to convert it to fixed. Okay, so let me just change the tabs here. Oh, no, so we don't want to copy it. Okay, so tab color. So I want to go with green here and then maybe just a different color here, maybe purple. Okay, so this tab here, I'm just going to make it a little bit bigger. Okay, so this tab here says, okay, I'm going to switch from my variable to my fixed right now. Okay, so as of today's date or yesterday's date, my new mortgage amount is 277. So I need to update it to 277 because I've been, even though my mortgage started at 300, I'm not going to be paying 5.04% on 300,000. I'm going to be paying it on the 277 going forward. Okay. And then, so what that means is I have about 23 years left on the mortgage, and I'm going to start, let's say yesterday, keep it on the weekly. So my payments go down. So this is a bit of a relief, right? Because now it's $60 every week. So about $240 a month potentially that, you can use that cash to go and pay for other living expenses, especially right now with inflation and the cost of living being so high. Okay. So here, our balance now is, we have another 2 years left on the term. And so now our outstanding balance at the end of the 2 years is going to be 259,000. So at that time, you're going to look at whatever's available in terms of mortgage rates and decide, do I just want to renew or do I want to go and refinance with your existing bank or with another institution? Okay, so there's different ways to handle that. So right now, we're just focusing on right now. Okay, so now when I was looking at this, I'm like, whoa, wait a minute, how come my actual interest payments are actually higher? Okay, so this is because I've decreased the amortization now to 22, 23 years. And so we're not comparing apples to apples here in the sense because the other one was at 25 years and the other one was at a higher loan amount. Okay, so what we're just looking at is just the 2-year time frame that's remaining. Okay, so what we're saying is that in that 2-year time frame, you're going to save about $6,700, which is a great amount to save. Okay, so now we're going to run the scenario saying, okay, let's wait. Okay, we're going to wait a little bit because we think the rates are going to go down even more. And if we wait, then we should be able to save some more money. Okay, so let me show you the summary on why that's a bit of a misconception. Okay, so your payments go down to 385,000 weekly. So yeah, you are saving about $100 a week now. So that's about a $40 increase in savings, which is fantastic. So because there's about, so in this case here, I started in January. So I'm saying, okay, we're going to wait 4 months left. So we're going to wait 4 months until the rates go down. So there's a bit of a difference in the lag there, right? So in the remaining amount of time in our term, we're going to save about $8,500. If we had stopped our calculation there, it would make sense just based on the, the 8,500 compared to the 6,600. It would make sense to wait and switch potentially in January when the rates go down to 4.04. Now, here's the thing though, you need to take a step back and think, well, wait a minute here. If I wait till January to switch over, that means I have to stay at this 6.1% rate at $484 a week, accelerated weekly, until that time I switch. So that means I'm going to be paying an extra amount every single week until I switch over. Okay, so here's the math here. So, but I have to pay a higher variable for the extra months. So during that time, I would have paid $6,577. So that's how much more I would have had to pay. Okay. So that means that my actual savings now has dwindled down to just under 2,000. Okay. So if you do the math to this point, you'll be like, well, wait a minute, it doesn't make sense to wait, even though that the rates will be lower. And even though I'll be in the remainder of my term, which is the 2 years, I'll be in my term at a lower rate. You're actually not saving that much more money. Like you're actually saving less money by waiting. Okay, so that's one way to think about it. So let me now just show you how that calculation came up. Okay, so let me make this a little bit bigger. Okay, so if we waited, so I'm just going to use the same amount here. Yeah, so instead of figuring what my mortgage amount will be in January, which is easy enough to do because I can just go here. Yeah, because I chose January here. So you know what? Let me just fix that because actually that's not hard to pull because I can just go in here and go January 25. So I can just update that here. So the mortgage balance is going to be 273,360. So it's not that big of a difference. Okay, so I'm going to just copy this cell. How do I copy? Oh, copy there. And I'm just going to go and I'm going to paste it. And I'm just going to put the number in. Okay, so it just pulled that number. Okay, so I'm going to just put burgundy cell. Yeah, so I want that burgundy in there. So I'm just going to put a comment in here so that I know. On the variable tab. Okay, so it's about $1,000 difference there. So it wasn't that big of a difference. So let's just say if we waited until January timeframe, the banks are going to allow us to go down to 4.04. So we're saving quite a bit there. So our weekly payments go to $380. Okay, so that's about, that $100 difference every week. Okay, so now instead of a 2-year difference, there's a 1.66 year difference. So we're going to still finish our term around August, around, September 2026. Okay, so our outstanding balance at that time is 258. Okay, so, so there's a few things to consider here. Okay, now if we just compare, let's just say now, so now what we're doing is we're just saying this is the amount of interest that we would have paid in that 1.66 year time frame. Okay, so that's fine. So in this summary, the way I calculated this 6,577 was basically just taking the sum of all the variable payments from the variable tab, just from this table here. Like it basically breaks it down. Let me just go up so that you could see the table headings here. The payment date, how much went to interest, how much went to payments, like the principal payments, and then what the balance is. So it's basically just calculating the interest that I paid during that time frame. So it's not taking the interest amount. Okay. So it's purely just saying, okay, if I waited, 5 months, and roughly here, it's $340 in interest payments each week. Okay, so that means you take that 340 times the number of weeks that we're delaying switching over to a variable, and that's how this 6,577 is calculated. Okay, so if you are in a situation and you're like, Hong, I'm in a variable and I think I need to switch over to a fixed. Okay, I agree that that is definitely a good question, a good scenario to look at. Now, should you wait to do it now or wait till the next rate drop or 2 rate drops down because you think it's going to go even lower? Based on my calculations right now, it is better just to switch over now. Okay, if you want access to this spreadsheet, please just email me. Happy to send it over. The only thing I would ask is for us to hop on a call so I can walk you through it to make sure that you're using it correctly. Okay, if you have a mortgage agent that you're working with, I'm happy to send it to them and have them, then I'll leave it with them to walk through it with you. Okay, so that is the topic for today. If you have anything you would like me to calculate for you with regards to real estate and money, please just shoot me an email. Happy to do so. Okay, thank you, everybody. Oh, it's a statutory holiday today. So even though I am doing this video, because I'm committed to doing a video every single week, yeah, wishing everybody a happy long weekend, and just appreciate the time that you have with your families, everybody. The summer's going by so fast, and before you know it, we'll be back in the school year. So just sending all my love and appreciation and gratitude to everybody who's watching. Thank you so very much. Have a wonderful Monday, everybody. Bye.